Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow in which we invest additional money on the first trading day of every week. They're the Dividend-Growth portfolio, which was started in 2022 and now has an annual return of 17.69%, and our high-yield stock portfolio, which is an annual return of 19.29% per year and is beating the S&P 500. The high-yield portfolio was started in 2023. Now on the chart, I've also included their benchmarks in blue for comparison. I recently started putting the list of dividend growth stocks we buy each Monday on a Substack newsletter. You can sign up for the newsletter for free. You can find the link in the Substack newsletter, or to the Substack newsletter, in the video description. Again, it's totally free to sign up for. I'm trying out Substack to see what it's like as a platform, and since I'm brand new to the platform, the newsletter is nothing fancy right now, but should get better as I learn the platform. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students and I started last year, as outlined in red, and now has an annualized return of 15%. It's one of our newest portfolios, and because it's 100% invested in tech stocks, it's our most volatile portfolio. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three portfolios are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. Next week, we'll also talk about our wide moat and capital light portfolios, which are also beating the S&P 500. And as a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to read more about them if you like less frequent trading. Later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our dividend growth stock portfolio currently has 103 holdings. Our high yield stock portfolio has 39 holdings, and our tech stock portfolio has 26 holdings. Now here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite, since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so as I mentioned before, I've put it on Substack for free as an experiment to see if we like the Substack platform. So far, Substack is easy to use and turning out to be more fun than I expected. You can find the list of dividend growth stocks that we're buying on the first trading day of each week, either on Substack or on my website, beatthestockmarket.com. All the strategies are on beatthestockmarket.com, except for the wide moat and capital light strategies, which are experimental strategies so far. Now I found that the Substack has a notes feature, which are free for anyone to read. And last week, or 2 weeks ago, I posted 2 notes, one of which included the list of capital light stocks we bought for our capital light strategy. And I guess I did post these this week too, so I'm trying to post these every week. If you're interested in that, sign up for free on Substack and feel free to leave me a comment to let me know to post either the list of capital light stocks we buy each week or the wide moat stocks we buy each week as part of our wide moat strategy. I don't want to make a routine of posting them each week if there isn't much interest, but I have no problem posting them as long as there's interest in them. Again, that's the wide moat strategy and the capital light strategy, free on Substack via their notes feature if you guys are interested. So in this green box, note that I've added a note that these 3 strategies are newer, and therefore the average investment has been held for less than a year. This means their annualized returns will fluctuate a lot until the holding period eventually grows. For example, the capital light strategy is by far the newest, as it was started in February of this year. Down here in the smaller box, you can see that the capital light strategy has an average holding of 58.7 days and has a return during those 58.7 days of 5.44% per stock. That's the average return. Now that gives you an annualized return of 39.05%, but that should be taken with a grain of salt. All it means is if a stock's price increases 5.44% every 58.7 days, you get an annualized return of 39.05%. So just be aware that the annual returns of these newer portfolios, down here and in green up here, will jump around a lot more but because they're have a short holding period so far. But over time, their returns will settle down as the holding period gets longer and longer. Now this slide is showing the portfolio value over time for our original portfolio, our dividend-growth portfolio, which invests almost exclusively in dividend-growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $3,000 after 178 weeks. Each week, we take that deposit, split it up to buy 10 different dividend-paying stocks. We're buying fractional shares of stock. Each week, we re-rate the stocks, so the list of stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in higher yield dividend-paying stocks. Now, the tan line on this chart shows what the portfolio value would be if we just put the money into a savings account. Now, in our first year, 2022, stocks did not do well. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November 2023, and it's taking off again once it was announced that the tariffs have a 90-day pause. And for those who have been asking, all three of the portfolios are now on our website, which is beatthestockmarket.com. We post the stocks we're buying in real time on Mondays when we make our weekly investments, as long as Monday's not a holiday, and anytime we sell a stock, as well as information about portfolio holdings and trade confirmations. Now, if you're new to my channel, I'm an accounting professor that teaches accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them the accounting concepts in action, we started this dividend growth stock portfolio in 2022 as a class project in which every Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. And just because we buy stocks every week doesn't mean a person wanting to follow this would need to buy them every week. You could do it every 2 weeks or once a month. You get less diversification, though. Before getting to which tech stocks we bought last week, a lot of people have been asking what my favorite books about investing are. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book, especially if you're a numbers person like I am, is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis for 2 of the 3 stock screens I publish on our website, beatthestockmarket.com. They are the Trending Value stock screen and Consumer Staples stock screens. I update those stock screens monthly. So what's a stock screen? It is a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of those stocks. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. And if there's interest, I might eventually do some videos about those, about which metric is the best. There are a lot of tables and graphs in the book, so if you're a numbers geek like me, you'll probably like it. It also talks a lot about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. Same with What Works on Wall Street, though that one's a little bit more complicated. But I prefer it. It's a little bit better. Now, if you're wanting an easier read that's shorter, go for Millennial Money. If you really want the better strategies, try What Works on Wall Street. But check your local library to see if they have a copy so you can save yourself some money. And I'll put links to the 2 books in the description of the video. And let's look to see how our portfolio has done versus a main dividend-paying ETF called SCHD. So SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend growth classroom stock portfolio's annual return is 17.69%. If we'd instead invested the same exact amounts into SCHD on the same exact days, the portfolio's return would only be 4.32%. Our high yield portfolio is also outperforming SCHD. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting into our dividend-paying classroom stock portfolios. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the selection. SCHD had at times had large positions in stocks I consider to be value traps, and that's not a good thing. Now this slide shows our best performing stocks for our original portfolio, the dividend growth stock portfolio, based on when they were initially purchased. Stocks in yellow, like Evercore and Crane Holdings, have been sold. Broadcom is in first place still, this time with a 332.3% return. Evercore, an investment bank, is in second place with a 252.9% total return. It's been sold. The fastest risers that are still in our portfolio are Bank of New York Mellon, which has more than doubled in 19 months. Perdoceo Education, up 108% in 21 months. Goldman Sachs, which is up over 102% in 26 months. And new to the list this week, Build-A-Bear Workshop, which is up 75% in 14 months. You'll see soon that on the next slide that it went way up this week due to quarterly announcements that were excellent. And remember that total return includes both the dividends the company has paid as well as an increase in the stock price. Now, let's look at the strategy column, specifically the category called dividend growth stocks. So over 90% of our investments in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been invested in usually smaller, under the radar companies that have recently started paying a dividend. These under the radar dividend payers, like Crane Holdings, tend to be riskier because they're usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. This slide shows our best performing dividend growth stocks in the portfolio this week. It does not include dividends. The best performers were Build-A-Bear, which was up 27.9% because of a stellar quarter that they had. Lamb Weston up 8.6%. Perdoceo, Papa John's, Fidelis, Broadcom, Intuit, and Prologis. And on this slide, these are best performing dividend stocks this week for our high yield stock portfolio, which has far fewer holdings than our dividend growth portfolio. The best performers were GlaxoSmith, Papa John's, Amgen, Novo Nordisk, and Darden Restaurants. So here's a usual disclaimer. This presentation is for informational purposes only. It's not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. Now let's talk about the dividend growth stocks we bought on Tuesday, since Monday was a holiday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the top 10 stocks. And of course, I posted these also on Substack. On this slide are my ratings for the top 20 dividend-paying stocks last week, but we only buy 10 per week. We purchased the first 10 stocks on the list that are not in yellow. The two in yellow are Microsoft and Legion. Those were not candidates for further investments because they are already at 4% or more of our portfolio. We want to keep the portfolio we want to prevent the portfolio from becoming lopsided and heavily weighted in one or two stocks. So anytime a stock gets to 4% or more of the portfolio, we stop investing in that stock. And remember, we use many criteria to filter the stocks, and if a stock is hovering near the required level of a certain metric, the stock can make the list one week and then drop off the list totally the next week based on a small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. Now, for consensus earnings growth estimates, I will only purchase a stock if for this strategy if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. That's why it's a dividend growth portfolio. A stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. And just because a stock no longer appears on the list does not mean we immediately sell it. Each week we buy 10 stocks, like I mentioned, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. For those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks we're purchasing that week. We think it's better to reinvest in stocks that we think are undervalued rather than just automatically reinvesting in a stock which could be fairly valued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these strategies. And this week I purchased over $3,000 of the stocks from our different strategies as I sell off SCHD, that dividend-paying ETF, gradually, and reinvest in these stocks. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% or so of our purchases. The other 10% or so have been invested in smaller, usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend payers tend to be riskier because they are smaller companies, but studies have shown these historically beat the market averages by a significant amount. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. And let's look at our quality rating, or let's talk about our quality rating. One of the components is moats, a measure of competitive advantages. One advantage of companies with the best moats is if they pay dividends, they are more likely to increase dividends even during an economic shock when compared to companies with no moat. On this slide, Morningstar shows their three categories of moats. On top, we have the companies with wide moats, which is considered the best. Then we have the narrow moats and then the no moats. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends despite many companies being in financial trouble. Only 18% or so cut their dividends. Now for companies with no moat, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. Now, our quality ranking for stocks includes moats, but it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers the 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year. And here's a look at the top 10 stocks that make up our largest portion of the dividend growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest in one single company. Aggressive investors might not want to limit the stock or in the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Now, our portfolio holdings are 103, with 92% of the weighting being in the high-quality dividend growers and 8% of the portfolio's weight being in those under-the-radar dividend payers. Remember, those are companies that have recently started paying a dividend for the first time. We usually make far more additional investments in the dividend growers than the under-the-radar dividend payers. So far, around 100 to 105 stocks seem to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. And of course, the number would be lower if you left off the under-the-radar dividend payers. Now, 103 might seem like a large number of companies to keep track of, but the spreadsheet we developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and does not take that much time. The thing that was time consuming was creating the spreadsheet and learning how to use it. It took about 2 long years of hard work. All right, let's talk about our high yield dividend paying stock portfolio. I've had several older students who are close to retirement take my classes. They are more interested in stocks with the higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into a separate portfolio, and those are stocks. It's comprised of stocks with higher dividend payouts. The portfolio as a whole has an annual total return of 19.29%. Currently, the high yield portfolio's dividend yield, if you waited until today to buy all of the stocks, would be 4.32%. Compared to our dividend growth stock portfolio, the companies in the portfolio likely will not grow their dividends as fast. Therefore, this portfolio would be more geared towards investors close to retirement. Having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks high and reinvest into better bargains, pushing the portfolio's yield based on the amount we invested to 4.86%. Now, 2 strategies are being implemented in this portfolio, as you see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1, in an attempt to try to get the best of both worlds, that being high yield and dividend growth. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 13.51% and has been held for an average of 230.9 days so far, which is an annualized rate of 22.2% using Excel's rate function. Now let's talk about our high yield dividend paying stocks that we bought last Tuesday, since Monday was a holiday. I posted these rankings to our website on beatthestockmarket.com last Tuesday, and then we purchased these 8 stocks. And normally there's a lot of overlap between the 2 strategies, but this is the first week in which all 4 stocks were the same, but just with a different ranking. And because the high yield stock portfolio currently has less than 1% in tech stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, a company I love, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have as good a chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off, so don't chase yield. One thing that's different about this higher yield strategy versus our dividend growth strategy in the previous slides is we only purchase 8 stocks and we have 2 different strategies, like I mentioned. And because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. And like I said, this is the first week that we've had all 4 stocks being the same, but a slightly different order. Now, both strategies still only invest in high quality stocks, meaning a quality ranking of B- or better. The 4 high yield stocks we bought last week while implementing strategy 1 in order are Comcast, Merck, PepsiCo, and EOG Resources. And then there were the same companies for strategy 2, but a little bit different order: Comcast, Merck, EOG, and then Pepsi. And here's a look at last Tuesday's ratings for competitive advantages, management, and financial health. On this slide, we can see last Tuesday's grade for recent dividend growth and current yield, as well as recent dividend growth history. In the last column, we can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And this slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Dividends for the latest month, which is May, which just ended, increased 44.8% over the same month a year ago. The chart shows how quickly the dividends are growing in the portfolio and is a great example of the power of compound growth. You can't underestimate how powerful that is over time. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. In this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses. The level I've reached despite being on a teacher salary, but I'm trying to reach the double. I'm trying to reach the level of where the income is double the annual expenses. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Once again, we had several dividend increases for our portfolio stocks. 6 companies in our dividend growth portfolio increased their dividends in the last 2 weeks since our last video, with 3 being double digits. The last 22 dividend increases for the portfolio have an average of 7.1%. So why do we only invest? Oh man, I skipped a slide. Let me go back here. So why do we only invest in dividend-paying stocks in our 2 main stock portfolios? The first reason is, according to Hartford study, over the past 51 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.2% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.31%. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks historically on average. Now, the second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you're to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you see on the screen, risk and volatility of dividend-paying stocks is measured by beta, and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, on the right side of the slide, you can see that the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios of dividend-paying stocks only invest in dividend-paying stocks that have increased their dividend recently. And the growing dividends, this also includes companies that have initiated their dividends. Now, BlackRock recently released a report showing that $10,000 invested in companies that increase their dividends, called dividend growers, over here, and companies that started paying their first ever dividend, called initiators, down here, initiators, grew to 2.6 million. That same $10,000 invested into non-dividend paying stocks only grew to 1.2 million, a difference of 116.7%. And when compared to the S&P 500, which contains both non-dividend paying companies and companies that do pay a dividend, the dividend growers and initiators performed 62.5% better. So not only do dividend paying stocks historically have a higher return on average than stocks that do not pay a dividend, dividend paying stocks also historically outperform the S&P 500. They also have less volatility on average, and they perform better than non-dividend paying stocks in down markets, also called bear markets, by 1% to 2% per month, not per year. This is very important because what causes investors to panic and sell at the worst time is when they see the value of their stocks plunge. But dividend paying stocks tend to hold up much better in down markets than non-dividend paying stocks. Now, the holy grail of investing is having a stock portfolio that produces a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. I bought Broadcom, a chip maker, in 2020, just 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invest in that stock, I would receive $5.01 each year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 9.14% per year. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I'd started a dividend stock portfolio for the investment newsletter that I'd started at the time, and Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents per year. Seemingly not much to get excited about, but over the years, Home Depot has grown the dividend to the point where its yield, based on the original investment, is 31.81%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, that's why it's important to buy early and be patient. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and tax brackets are adjusted. So, how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did I choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck, or $50 a month? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my college accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week or $50 a month. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Obviously, with a small amount of money, we're buying 10 stocks or so, we're buying fractional shares. Now, originally, I invested $25 per paycheck into the dividend growth portfolio, but I found the process to be so fun that I split it up and now invest $12.50 each week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assume the contribution would increase or by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74 per week. For our classroom dividend growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, inflation was even lower in 2024, so we boosted the weekly investment by only 37 cents for 2025, so we now invest $14.18 each Monday. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there's 4 potential ways to boost a portfolio's returns. Now remember, we got over 100 stocks in the portfolio, so it might be very easy for you to give up some diversification. So each week on the first trading day of the week, I post the top 20 dividend growth stocks on beatthestockmarket.com. The list was also shown earlier in the video. Now, of those 20, I buy 10 different dividend-paying stocks ranked 1 through 10. Of those 10 stocks, on average, the stocks in positions 1 through 5, in other words, the higher ranked stocks, outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5. In other words, the top 5 rated instead of the top 10 rated. However, the downside is this reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns 66.7%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2. You could try not limiting individual portfolio holdings to 4% of the portfolio's total value. Now, normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses plus generate extra income for vacation, travel, etc. I'm a conservative investor and I'm personally investing a lot in these dividends portfolios, so I wanted to make sure the portfolio is not only well diversified between sectors but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it does not affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try limiting the 4% limit or might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in bullet point 1. So far, not limiting individual stocks to 4% of the portfolio would have improved annual returns by 73.9%. But again, I personally prefer a more diversified portfolio. Number 3, the under-the-radar dividend payers. Remember, those are companies that recently started paying their first ever dividend. Despite having some incredible performers like F&G Annuities, 119% gain in 12 months, and Repositrax, 97% gain in the same time frame, and now Build-A-Bear having an excellent return. Those under-the-radar dividend payers on average have not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. Now, one possible reason these stocks haven't done quite as well as the dividend growers is because many of the under-the-radar stocks are very small companies like Build-A-Bear, and small stocks have not performed as well in recent years. Like the previous strategies, this method reduces portfolio diversification. Number 4, you could potentially sell a stock when it's fairly valued, even if dividend quality metrics are excellent. Now, we don't sell often in the portfolio, definitely not every week, and tend to only sell if the company cuts a dividend or the stock appears to be overvalued or is approaching overvalued, or the company's dividend quality metrics fall out of the top 50%. In other words, if a stock appears to be fairly valued, but the dividend quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals the stock is fairly valued or even overvalued, you might try selling it at that time and reinvesting in that week's 10 stocks that we're buying. The downside would be a higher turnover, but this could boost the portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd like to hear what your results are. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. And for those looking for a less hands-on approach, let's talk about some ways to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rules that say to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paychecks, which is usually paid every 2 weeks. And it's automatically invested in their 401k. Now, when I started our dividend growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is to get more diversification. So if one doesn't mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just be very small parts of your portfolio as you let your winners run. That's it for this week. In the comments, let me know if you have any other questions. Also, let me know what portfolios or investment strategies you would like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn and Twitter, and now Substack. I'll talk to you next week with another portfolio update, most likely about our tech stock portfolio, our wide moat strategy, and our capital light strategy. See ya!